Risk thinking is instinctive in intelligent organisms, but some people or organisations do it much better than others. Here is a brief history of risk to put modern risk thinking into perspective. The earliest example of structured risk thinking was in the 3rd millennia BC. Ancient Chinese merchants navigating treacherous rivers would distribute their wares over many boats to limit their losses due to any single boat capsizing. Later, in ancient Greece and the Roman Empire, lenders would estimate the risks of providing loans and compare that to the reward they would receive in terms of the interest. This enterprise eventually gave rise to banks. In ancient Athens in the 4th century BC, the concept of the maritime loan was born. These loans covered a merchant ship's voyage, and repayment was cancelled if the ship was lost. Rates for the loans varied according to safe or dangerous times of year, and whether the route was deemed to be easy or treacherous. This had an effect similar to modern insurance. During the 17th century in London, insurance branched out from the merchant shipping industry to cover life and health insurance in a form that's familiar to us today. So the finance and insurance worlds have been practicing risk calculations for a long time, and not surprisingly, they have become very good at it. But it wasn't until the 1960s that structured risk thinking was applied to health and safety risk. The Canadian nuclear industry, aware that they were dealing with highly hazardous materials and processes, decided that they needed a more structured method to manage their hazards. By taking into account the severity of consequences of an accident and the likelihood of that event happening, they successfully modified numerical methods of financial risk management to represent health and safety risks. 2 decades later, after the Piper Alpha disaster where an oil rig in the North Sea caught fire and killed 167 men, the global oil and gas industry followed suit and adopted the risk management process as developed by the Canadian nuclear industry. Slowly, over the decades that followed, the use of the risk management process has filtered down through the high hazard industries like mining and construction to the lower hazard industries, and most countries now have laws that require all businesses to use the risk management process to manage health and safety risks. Fortunately for us, it's not rocket science. It's actually very simple. And with a small amount of guidance, everyone can benefit from using a bit of structure when making decisions about risk.